Hello guys and welcome again to my channel. So this is the worksheet that we have talked about in the past episode. So this is, I guess, the step 5. Yeah, it's the step 5 of the accounting cycle, which is the completion of the worksheet. And for review, we have here 10 columns. So we have the account titles, and aside from that column for account titles, we have 10 columns right here. The first two columns is for the unadjusted trial balance. The third and the fourth is for the adjustments. The fifth and the sixth is for the adjusted trial balance. And the seventh and the eighth is for the statement of comprehensive income or income statement or statement of performance. And we have right here the balance sheet or the statement of financial position. Okay? But before we go to step 6, which is the preparation of financial statements. So that's where we are. Preparation of FS. Let me emphasize that the completion of worksheet is just optional. Okay? Actually, you don't need to complete the worksheet. Especially if ever, on the step 3, on the making of the ledger or T accounts, you already included the adjustments. Because in the past, what we did, in order to make this unadjusted trial balance, is we excluded the adjustments, if you can still remember, right? So if we did not exclude the adjustments, then you will come up with this adjusted trial balance. And from these adjusted trial balances, you can already make financial statements. So you don't need actually to complete the whole worksheet. But I really wanted you to know how to make this worksheet, so we did. Okay? Now, let's go to preparation of FS. Actually, there are 5 financial statements. We have income statement or the statement of comprehensive income. We have the statement of changes in equity or the capital, statement of changes in capital. And we have, of course, the statement of financial position. And lastly, we have still statement of cash flows. That's the 4th one. And the 5th one is the disclosures. Okay? Now, of course, we're not going to make an example of these disclosures based on the problem because these disclosures are just compositions of what are those balances, especially the adjusted balances. Like for example, cash. The cash is 117,950. So on the disclosures, you expect that that cash composition will be detailed. Like for example, how much of that cash is on hand or in the company's vault or in the company's bank and which banks. So that is just the purpose of disclosures. Okay? But let me elaborate. The disclosures is actually the part of the financial statement or component of financial statements that is the longest. There are a lot of pages in there because aside from composition, the first is on the disclosures, there will be company information. So, when was it registered? What is the business permit number? What is the Securities Exchange Commission number? Something like that. So, any other information is put in there, the profile of the company, so that the readers or the users of financial information will know the profile of the company which owns the financial statements and to know if the company is legit. Okay? And of course, the second one, aside from the composition again, aside from the profile of the company, is what are the accounting standards that are being followed by the company. So it's in there. Okay? And those business transactions that needs to be disclosed because they are material, but they cannot still be incorporated with the financial statements, probably because of measurability problems, something like that, it will be put on the disclosures. Okay? So you can already imagine how thick the disclosures is. Okay? So, for this particular episode, that's all the things that you have to know about disclosures. Again, it is composed of profiles, it is composed of accounting standards that it follows, and of course, it also composed number three of accounting policies that are being followed by the company because sometimes um, a particular accounting standard gives you a freedom to choose what accounting policy to choose. Okay? So, accounting policies. And the fourth one, compositions of the accounts, especially the adjusted balances. And then number five is the other disclosures that are so material that even if it cannot be incorporated yet in the financial statements, they have to be mentioned. Okay? So those are on the disclosures. So that's 1/5. Let's go to income statement and statement of comprehensive income. Okay? So on the statement or income statement or statement of comprehensive income, what you only need is to formalize the seventh and eighth. Okay? So you have to make a title, like for example, BBG Company. You can also put in on a logo of BBG Company. So no. Statement of comprehensive income, right? And then for the period ended, blank. Let's put in blank. So that's the heading already of the income statement. And then let me discuss about for the period. Because if we talk about income statement or statement of comprehensive income, you have to use that for the period ended. Why is it? So, this statement features only the revenues and the expenses right here. Okay? So the revenues and expenses are considered as temporary accounts. It is because at the end of the period or at the end of the year, they will be close to the capital account. Okay? Which means, if this period has an income and expense like this, and at the end of the period they will be closed, on the subsequent period or the next year or the next period, the income and expenses right there is another batch. Okay? So, which is why we need to emphasize that the income and expenses that we're talking about is for this period only, for the period ended, for example, 20x3. Because on 20x4, there will be another batch of income and expense amounts. Okay? So that's it. Now, let's formalize. So we have service revenues. So service revenues, since there is only one type of revenues in our example, you can go directly to the rightmost part of the sheet. So we can put here 61,000. Yeah. And then we have less expenses. So since there are a lot of types of expenses in our example, to be specific, we have 1, 2, 3, 4, 5, and 6. We have to enumerate them. So let's start with regulatory expenses, which is 6,000. And of course, we have supplies expenses. The supplies expenses, no. Okay, sige. Let's have the supplies expense. We have 16,500. I guess the regulatory expense is not, it's 2,3 only. So let's change it. It's 2,3. And after the 2,3, it's not supplies expense yet. It's utilities expense. So we have here utilities expense. Yeah. Utilities expense is 19,750. And we have rent expenses, which is 6,000. So that's the 6,000. And we have the supplies expenses. Supplies expenses is 16,500. And we have depreciation expense of 983.33. And lastly, we have salaries expense of 3,000. So you can check it if ever we're going to add the expenses, if it will match the 7th and 8th in our worksheet. But let's do that so that we can check. So let's not copy immediately the expenses in the 7th and 8th, okay? So we have 23 plus 19,750 plus 6,000 plus 16,500 plus 983.33 and then plus 3,000. And we have 48,533.33. 48,533.33. And we have to deduct that, and we're gonna get the net income. So supposedly our net income in the 7th and 8th matches here. So minus 61,000, we have 12,466.67. Did it match? Yes, it did. So that's it for the income statement. But before we end, I would like to emphasize something. So in that particular form or particular format of statement of comprehensive income, you have a lot of freedom right here because we use 2 columns. Sometimes you can use 3 columns and you can do this indention. Okay? But in the actual practice, it's not like that. It is because normally the statement of comprehensive income in 1 year or 1 period, it is only 1 column. So what will happen? You have to put the 61,000 right here because we only need 1 column, or we are given 1 column only. And this 48,533.33 is here as the total expenses. So the net income will also be here. Of course, you have to make the 61,000 and 48,533.33 here as format it in bold format so that it will be emphasized that they are the totals, total revenues and total expenses. Okay? And of course, this amounts right here, it should be emphasized that it is negative. So there is an open and close parenthesis in each of these numbers. Okay? So why is that? Because in the actual, if you are going to present the numbers for the current period, you are required to compare it with the past numbers. For example, if this is 20x3, the 20x2 numbers are also presented for comparison purposes. Okay? So basically, that's the statement of comprehensive income. And let me emphasize again, this should be the first financial statement that you are going to make. So this is the first on the hierarchy, followed by this one. And you will understand later why. So let's talk about the statement of changes in equity later. So we are at 2 financial statements already out of 5. Okay? So now let's go back. So again, this is the statement of comprehensive income and it is labeled for the period ended. Okay? So next is we will have the statement of changes in equity. So let's erase this one. And let's change the title. So BBG company still, that's the heading, and if possible, you should have a logo for the company right here to complete the heading. So we have statement of changes in equity or capital. So this only talks about the capital ending of the owners, okay? And as you have remembered, I told you that there are only 4 items that will change the capital. So meaning, if we have a beginning capital right here, beginning capital balance, one of the things that will change the beginning capital balance is the first is the investment from owners, right? You still remember that. And then, what will be deducted are withdrawals from the owner, withdrawals by the owners. And we have the other two, the revenues and the expenses. Okay? But since on the income statement a while ago, or the statement of comprehensive income, we have already summarized the revenues and expenses. What we're going to put right here in the statement of changes in equity is the summary already of the revenues and the expenses, which is, for example, if it is positive, like in our illustrative problem, net income, you're going to add that. Okay? But if it is a net loss, then put also net loss. Something like that. So that's what you are going to do only. You start with the beginning capital, and then you put on the 4 things that will change the capital balance, which is the investment, the revenues for additional capital, of course, that will add on the capital. And then those that will deduct is, of course, the withdrawals by the owners and the expenses. But then again, let me emphasize, in the statement of comprehensive income, since the income and expenses are already summarized, what will be reflected here in the statement of changes in equity, instead of separate revenues and separate expenses, we're gonna have net income if the revenues are greater. Okay? And net loss if ever the expenses are greater than the revenues. Okay? So, this is it. Okay? Now, let's fill this up. For example, on the beginning capital, what is our beginning capital in the comprehensive problem that we have, BBG company? That's 0. Why? Because beginning capital is only positive if ever the company started already in the past. Like, this is already the year 2 of the company, year 3, year 4, di follow? So, if ever it has started already in the past, the ending capital balance in the last year will become the beginning capital balance for this year. Okay? But since in our comprehensive income, we started only this year or this period, which is why we have business permits and registrations and etc. So, basically, the beginning capital balance for this comprehensive problem that we have is 0. Okay? Now, let's go to investment from owners. Of course, you have remembered the investment from owners is 100,000. So that's what we're gonna use. Okay? So 100,000. So that's the initial capital investment of the owners. And of course, we resulted to a net income. So this net income is 12,466.67. And let me emphasize that that is based on the income statement, the summary of revenues and expenses. So meaning, this particular amount here will not be present if you have not started with statement of comprehensive income. Which is why, again, the first financial statement that you should prepare is the income statement or the statement of comprehensive income. Okay? because of this. Okay? Now, let's go to the withdrawals of the owners. But before that, let's total first. So the totals is 112,466.67. And then we have withdrawals by the owner. So we have 25,000. So we have to deduct that. So that's it. We just have to summarize. So we have 100,000 plus 12,466.67. We have 112,466.67 minus 25,000. We have the ending capital balance of 87,466.67. And that will become the beginning capital balance for next year if the company will continue on the next period. So that's it for statement of changes in equity. Now, let's move to statement of financial position in a little while. Okay? So, this is again the statement of changes in equity. Okay? So, for the last financial statement that we're going to talk about in this episode, we have statement of financial position. No, not yet. Smiley. The statement of cash flows, we're going to have a separate episode for that one because I have something to tell you. Meaning, the statement of cash flows is actually, I need more time to discuss this with you. So let's dedicate a single episode for it. So our last financial statement that we're going to talk about in this episode is the statement of financial position. So this is, again, the statement of financial position. So it's still Baby G Company for the heading, statement of financial position. And then as of, for example, December 31, 2023. So this is now as of, okay? Not the for the in the income statement. It is because what will you see here are not income and expenses already, but the other accounts which are considered as real accounts. So these accounts like cash, accounts receivable, supplies, and etc. This will not be closed at the end of the year, unlike the income and expenses. So if the income and expenses are considered as temporary, these cash receivables, which are not income and expenses, are considered as real accounts or permanent accounts. Okay? So they will just be changed because there will be some entries in the debit and the credits. But essentially, for example, this cash is 117,950. It was not closed from the very beginning of the business until now. So that's the cumulative effect of all the transactions related to cash until now. Okay? Unlike the income and expenses, they will be closed. They will be closed at the end of the period, and then they will start again another batch of income and expenses for the next period. Okay? Which is why that is as of. Okay? So cash as of now. So from the very beginning until now. Okay? So how do you make a statement of financial position? So the statement of financial position can be in a format like this. So we'll start with the assets, of course. So on the assets, we'll start with the current assets. And the current assets, of course, it will start with cash. And then we have the accounts receivable. So let's list all of them. And then we have the supplies. And then we have the prepaid rent. I guess that's the last one. Yeah, that's the last one. So we're gonna put the balances of the cash right here. We have 117,950. Okay, and you have the accounts receivable of 5,000, and then we have the supplies of from 20,000. Since it was adjusted with 16,500, we only have 3,500. That's it. And then we have the prepaid rent from 15,000. It is now 6,000. So based on that, let's have a total. So we have 117,950. 117,950. So you can help me. You can follow me in adding. We have 5,000 plus 3,500 plus 6,000, and we will get 132,450. 132,450 as the total current assets. And then we will have the non-current assets, in which we only have, how much do we have here? We only have office equipment. But this time, aside from putting on the amount for the office equipment, for example, we have the gross amount or historical cost of 30,000. You have to deduct from it the accumulated depreciation of office equipment, which is based on our problem, based on our computation, that's 983.33. So you're gonna deduct that because this is a contra asset. Because actually, your office equipment is not already 30,000 because you have used it for 1 month, if I'm not mistaken. Yeah, it's for 1 month. So the real value or the book value of your office equipment is only 29,016.67. And if you are asked how much is the total non-current assets, that's the answer. It's because we only have one non-current asset. And if you will be asked how much is the total assets, we have the current assets right here. That's this one. So let's add 132,450 plus 29,016.67, and we have 161,466.67. And that's it for the assets. So of course, we're gonna go with liabilities. And I guess we have three types of liabilities right here. So let's start with current liabilities. Although I guess all are current. So current liabilities, we have accounts payable, we have unearned revenue, we have salaries payable, and you will have 10,000 for the accounts payable, and we have the 80,000. No, not the 80,000. It's only 64,000. Yeah, and then salaries payable of 3,000. Okay, so let's total them up, and you have the current liabilities. So we have 10,000 plus 64,000 plus 3,000. We have 77. And supposing there is a non-current liability, there should be a section for non-current liabilities. But since in our problem we don't have any, let's put here 0, of course. And then we will have the equity. So a while ago, we have computed the equity to be, I have not remembered. So the equity is, I guess, 112,466.67 minus 25. That's 87,466. 87,466.67. And let me emphasize that this is just copied from the statement of changes in equity, which is why after the income statement, you should make first the statement of changes in equity before going to the statement of financial position, because you have to get this first. And if you cannot get this first, then you will not be able to complete the statement of financial position. Okay, so let's continue. 87,466.67 plus 77,000. You will have, oh no, I guess we have a difference again. 5,000 and then 3,500 and then prepaid rent. We have a difference of 3,000. Let me repeat again, huh? So we have 100,000 plus 12,466.67. It's 112, and then minus 25,000, and we will have 87,466.67. Okay, and then we have 64, we have 10, we have 3, we have 100, we have 25, we have 12. So that's 87,466.67 plus 77,000. That's 164,466.67. There is a difference of 3,000. So we might be wrong about the cash, for example. 117,950 plus 5,000 plus 3,500 plus, yeah, the prepaid rent is not 6,000. It should be 9,000 here. So again, you have to be focused so that you will not end up like this. So we have 9,000 right here. So instead of 132,450, we have 135,450 on the total current assets. So 135,450 plus 29,016.67, and you will have 164. So that's balanced. 164,466.67. So the assets is equivalent to the liabilities plus the equity. So those are the 4 FS that is featured here in this episode. So we started with the disclosures, which is just composed of, again, the profile of the company, and then the accounting standards that are being followed by the company owning these financial statements and transactions. Third are the accounting policies that they are following. Fourth, it's the compositions of the account balances in the FS, especially cash, accounts receivable. Like on the accounts receivable, how much are we going to collect or are collectible from customer A, B, and C? Something like that. And lastly, the other disclosures that are so important that even if it is not yet recognized in the financial statement amounts, it should be disclosed. Okay? So let's call that others. So that's disclosures. We have the income statement, which is just composed of revenues minus expenses. So that's the first one that you should make, because the net profit that is the resultant of summarizing revenues and expenses will be used in the statement of changes in equity. On the statement of changes in equity, that is just the beginning balance to ending balance. So the beginning capital balance, what will change it? Of course, the investment from the owners, the income or the net loss, and the withdrawals. So if you can incorporate those things into the beginning capital, you will come up with the ending capital balance, which is very much needed to complete the statement of financial position right here. So the statement of financial position is just a formal version of this ninth and 10th of the worksheet. Because as you can see, the 117,950 is there, the 5,000 is there, the 3,500 is there, the prepaid rent, which is 9,000, is there. Of course, the only difference is that on the office equipment of 30,000, in here, they are separated, but in here, they are combined already. They are netted against each other. Okay? But basically, this is just a formal version of the columns 9th and 10th of the worksheet. So the liabilities are also there. The unearned revenue, the salaries payable here. But the capital here is the unadjusted still, the investment only. It's because in here, you have to combine the withdrawals and the net income already. And you will come up with 87,466.67. Okay? So before I end this episode, actually, the statement of financial position that we have made here is what do we call as report format. Report format is the format wherein you list first the assets and then the liabilities and the capital. So that's the report format. So that's vertical in nature. You can also present the statement of financial position in the form of horizontal versions like A is equal to L plus C, where the A is still like this, but the liabilities will be on the right side and the capital is on the right side and on the A side. Okay, the horizontal format of statement of financial position is what we call as the account format. Okay, so again, the report format is vertical in nature, and the account format is horizontal in nature. So on the bond paper, it's as if this is portrait, this is landscape. Okay, so that's it for this episode. So if you wanted more, you have some links on the description on my playlist. So you can start with the first episode until now, or you can continue the videos. Apart from this one, I will be uploading other videos because this particular project that I have from zero to accounting hero is ambitious. So I'm starting now with the basics, but it will go definitely to higher accounting topics. Okay, like not-for-profit organization accounting, government accounting, or else parent subsidiary accounting, home office branch office accounting, and I wanted to see it through with you. So this is it for this episode, and see you on my next one.